From New York City for our viewers worldwide, I'm Shonali Bassick, and Bloomberg Real Yield starts right now. And coming up, an upside surprise to payrolls despite deep policy uncertainty, sending stocks and treasury yields higher as risk on makes a comeback. And joining us in just a moment, we're going to have a first broadcast interview with Robert O'Leary, co-CEO of Oaktree Capital Management. But we begin with the big issue, the labor market holding steady in April.
This is a good report all around.
This is a good report, and that's important.
The net trend is pretty strong. The challenge is looking forward. There's a pretty big cliff from an economic perspective heading into the next couple of months.
The reality is we don't know how this is going to play out.
Those 4 cuts that are being priced in look like recession cuts.
Recession's not our base case.
The rate market is rightfully factoring in. You got an economy that's still solid, that labor is still solid. It's got to keep the Fed on hold.
The markets have kind of repriced very quickly any kind of risk premium.
But I do think that Treasury yields will deliver that hedge that you expect in a bad state of the world.
I don't know about really buying the 30-year. That's just a lot. That's a risk asset.
You may have the back end, longer maturity rates not doing what you expect them to do.
We have momentum going into a difficult period, and the question just is, will this momentum be strong enough to get us through it?
Now let's take a closer look at those jobs numbers and how well they actually were, because non-farm payrolls came in almost 40,000 more than what the estimates were on average. But you also have average hourly earnings coming in at least month over month, a little bit cooler than expected. So a lot of good news here. But what does that mean for the Fed? Because if you flip up the board, you do see just the 2-year taking off this morning. Last I looked, it was 11 basis points higher. There has been an interesting amount of volatility at the shorter end of the yield curve. This is a place that investors have felt more safe relative to the fiscal risk. But you also had the Treasury Secretary, Scott Bessent, saying that the 2-year yield remaining below the Fed funds rate is a case to cut. Would that still be the case, though, if you have data that holds up this strong and inflation fears still under the surface? Now, former Secretary of the Treasury, Larry Summers, says that this is not the case.
I think it's pretty analytically unsound to reason from the 2-year to what the Fed should do. So I haven't studied Secretary Bessent's comments closely, but if he was making comments that could reasonably be interpreted as being prescriptive with respect to the Fed, that seems like a quite unusual choice for a Treasury Secretary, and a problematic choice as well.
Joining us now, Kelsey Berro, fixed income portfolio manager at JPMorgan Asset Management, and Ira Jersey, Bloomberg Intelligence chief U.S. interest rate strategist. Ira, give us the setup here for a moment. We have a lot of new data. We had that GDP number coming in below estimates, but you have jobs holding steady. What does it mean all for the bond market?
Yeah, well, if you look at the GDP data, and especially the March personal consumption data, the consumer was still fine come March. So going into all the market volatility that we've had the last month, the economy was pretty decent on a domestic basis. And then if you look at even this morning's jobs numbers, what you saw was the aggregate job figure, which I call aggregate labor income, taking into account hours and the hourly wage as well as the number of jobs. That's still growing at about 5% year on year. So that's a pretty solid growth rate. So the economy right now isn't falling into recession. The question is, what happens in 3 months, 6 months when all of the angst around tariffs and the like really start to filter into the overall economy?
I'm glad you're bringing out the longer term view here, because, Kelsey, that's a great way to pivot into your thoughts. How do you view the current economic data in light of the future risks?
Yeah, so I think Ira said it well. So far, the economy has been very resilient. It came into 2025 with a lot of tailwinds. The consumer was healthy. Businesses were healthy, corporate fundamentals were good, margins were high, consumers were still spending. Ultimately, the speed limit for consumption growth is income growth. Income growth is generated by employment. So if employment is still healthy, then income growth is still healthy and the consumer can still spend. That's the virtuous cycle that we have been in But that's a backward-looking statement. And what the market is looking for is, are we going to see a stalling out, or are we going to see a sudden stop as a result of what we know is an environment of very high uncertainty as it relates to consumers and businesses?
Now, here's the thing. The remarkable thing to me is not just the volatility you're seeing in the spot rates, but also in Fed funds futures, because you had more than 4 rate cuts, Ira, priced in a little earlier this week. You're down to 3.2 by the end of the year. That is a full percentage point change in expectations in just a couple of days. So if we do see a sharper fall off in the economic data, given the inflation threats, what kind of room does the Fed really have to cut this year?
Well, that's been the question that we've been asking ourselves. And if you even go out a little bit further, let's go out a year from now. We keep looking at December, but let's look at June 2026 and what's priced for that. It's 100 basis points of rate cuts now priced in. Was 150 or even a little bit more than that not so long ago. I think ultimately the Fed's kind of stuck in a hard place. And with data like we had this morning and we've gotten for the first quarter, with this overhang of potential inflation, the Fed's probably going to have to be on hold until it's clear that the job market is starting to slow much more substantially than any of the data currently shows. Once that happens, though, I think the Fed can go faster than what the market has been pricing. So it's more of not a magnitude issue, but more of a timing issue that I think the market's gotten wrong. So when you look at, what we call the front white, so the very short-term interest rate futures, they were probably pricing too pessimistic of an economy, and I think a lot of the data you've seen recently has played out that way.
Kelsey Berro of JPMorgan sticking with us for just one more question here. What about the trade here? Because you and I this morning were talking in the commercial break, and it was incredible. That 2-year spike of 11 basis points today. Did that tell you that the market was just mispriced coming into this?
Well, I'm not sure if it's mispriced, but there was probably a 50 to 60% probability priced into the market before payrolls that we were going to get a cut in June. And the data that we have in hand just does not necessarily indicate that the Fed is going to have the information it needs to start cutting rates. But I think it's very important to recognize not just debating when is the Fed going to start cutting, but I think history tells us, especially in the Powell Fed, that once they see the data, the hard data, roll over, they will not be shy to react and to react quickly. So think back to 2024. They held and they held and they held, and then just in the last quarter, they delivered 100 basis points of rate cuts. So if the data changes, they'll move.
Now, thank you very much. That is Kelsey Berro of JPMorgan and Bloomberg's Ira Jersey. Kelsey, you can't come on set with us without some more breaking news as well, because we are now hearing the Wall Street Journal reporting that Beijing is considering ways to address the Trump administration's gripes over China's role in the fentanyl crisis. And you do see the S&P spiking on the heels of this news. We're going to now bring in Balance of Power co-host Kayleigh Lines. What does this mean for the trade talks between the U.S. and Beijing?
Well, we have to keep in mind here, Sonali, that the current tariff level the U.S. has on Chinese imports is 145%. 20% of that was already implemented earlier this year over specifically China's role in the fentanyl crisis through the eyes of President Trump. The other 125%, of course, is the reciprocal rate that has been ratcheted up a few times, that is basically more to address China's trade practices toward the United States and the world overall. So in theory, this move from Beijing would be targeted at that 20% portion related to fentanyl. What the Wall Street Journal is reporting here, and Bloomberg has not yet confirmed this information, is that Xi Jinping's security czar, Wang Xiaohong, has been inquiring as to what exactly the U.S. would like China to do when it comes to some of those ingredients that are required in the making of fentanyl, has been making inquiries in that regard to see what ultimately might be able to address the U.S.'s concern here. Now, the people, according to the Wall Street Journal, who have been discussing this, say that the discussions are fluid, that China would like to see some softening of the stance and rhetoric from Donald Trump when it comes to his approach to Beijing and the trade offensive over versus China overall. But of course, this news follows the news we got from the Chinese Ministry of Commerce yesterday, suggesting they are evaluating whether to begin trade negotiations with the U.S., which in theory would be much wider than just addressing addressing the fentanyl-specific issue. But keeping in mind, Sonali, that this trade war that has been launched with China, what administration officials and President Trump himself have effectively described as an embargo the two countries have against each other, are for a myriad of issues. It is not just about the trade deficit with China, but kind of its manufacturing capacity and overcapacity of supply in the global market overall, in addition to the fentanyl trade, which Donald Trump says is also part of a drug war, not just a trade war. So it is the fentanyl component that the Wall Street Journal says China is looking specifically at here.
Kaylee, we thank you so very much. We'll, of course, bring you the latest developments as they happen, looking at an S&P 500 near session highs, now up about 1.5%. Now, amid all of the volatility, up next, we're going to talk about the opportunity that the biggest credit funds are seeing. I'm going to sit down with Robert O'Leary. He's the co-CEO and portfolio manager at Oaktree Capital Management for his first broadcast interview. Stick with us for that. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where we closed out issuance for April, a month full of volatility. And we start in Europe. On Tuesday, we saw the biggest rush of sales since January, when more than 28 billion euros was priced. Alphabet was the big highlight, with a deal that included maturities of between 4 and 29 years, which is the second longest corporate bond sold in Europe this year. Alphabet also had a $5 billion sale here in the United States, and it was the second largest deal this week, only trailing Citigroup. April, though, was the slowest month this year for high-grade sales. And U.S. high yield was slow in April as well. It was actually the lowest supply total for that month since 2008, with just over $8 billion sold. And when looking at private credit, Blue Owl co-CEO Mark Lipschultz told us this week that the recent round of market volatility is not slowing his company down.
Things are going really well. And this is the thing about uncertainty. Our business, all our lines, all our products, were built around downside protection, predictability, and stability. We actually have a business that is continuing to thrive. You have people coming on here right every day talking about, hey, they need to withdraw their guidance for the year. We're coming on here saying business is really good. Carry on.
Now, there's another executive who's looking to thrive amid the uncertainty, and that is Bob O'Leary. He's the co-CEO and portfolio manager at Oaktree Capital Management, which has more than $200 billion in assets under management. You know, it's interesting because Oaktree's known to thrive at times like this, to capitalize on dislocation. We've seen some of it already, but then you have new headlines, and it looks every so often like a new set of talks between maybe Beijing and the U.S., between Japan and the U.S., might start to relieve some of that pressure. But will it, in your view?
Yeah, so first of all, thanks so much for having me on, Sonali. I'd like to put this into the context of some other views we've had at Oaktree. And I'd go back to the latter part of 2022, where Howard Marks came out with a memo that I thought was quite influential. Howard made 3 basic points in that memo, which he entitled Sea Change. Number one, it's impossible to look over the last 40 years of financial history and disaggregate the effect of falling interest rates from the performance of financial assets. Number two, those falling interest rates were the product of really 3 forces: demographics, the peace dividend, if you will, and globalization. And the final point he made in that memo, which I think is very relevant for what we're talking about today, you're now at the point where all those forces are either stalled or reversing. Demographics is now a headwind, not a tailwind. The peace dividend is gone. We've got conflict around the world. And finally, globalization has gone to deglobalization. And I think the tariff news that we've had recently has punctuated that particular trend. I think it's reasonable to assume that we are in for higher and more volatile interest rates, no matter what the course of these tariff negotiations take. And as a consequence of that, I think we're in for more volatility in the credit markets.
Well, does this mean, in other words, that some of the damage has already been done? Because even if some of these tariffs were rolled back, the fact that they were put up in the first place, does it erode a sense of trust between the U.S. and trading partners?
I think that's an excellent point. We've been a reliable counterparty for the last 50 years. And I think these tariffs have caused countries to rethink their relationship with us. And they, we could go back to zero or close to zero, but it does introduce friction into those relationships, and people are going to change their behaviors based on this. You already see it. You see it in the Treasury market with yields going up. And I do think it has introduced an element of uncertainty that I don't know that we're going to get over easily.
What does this mean? How long can this go on for? You actually gave me a very specific timeline. You said 3 to 6 months.
Yes.
And that would mean much more damage for the economy. Why?
If you look at the trade flows, you're already seeing slowing in major ports around the import of goods. Container ship traffic has slowed down pretty dramatically. So it's slowed. You haven't seen the impact in the real economy because there was enough sort of on the water at the point where all this got introduced. But you're going to see dramatic slowing, absent any change, in May and in June. And that's going to have knock-on effects to retail and to logistics and things of that nature. And again, if nothing changes, you're going to see job losses. So it's almost mechanical at this point. I think you are setting into motion forces that will be very hard to reverse. And I think if, 3 to 6 months, you start to get into the holiday ordering season at some point, it's going to impact people's behaviors. And, I think it's really hard to reverse a lot of that impairment.
Is a recession a foregone conclusion at this point?
I don't think so. I mean, you could introduce a lot of measures. Again, you got to get things back to a more normalized state with our trade partners very quickly. But what I would say is this. We compare this to some other shocks that the economy has had recently. So you've had the pandemic. You've obviously had the 500 basis point rate move back in 2022. And now you have the introduction of these tariffs. We got through the pandemic really with flying colors because we had an unprecedented amount of monetary stimulus. The problem with doing that today is that you're starting at a higher point for inflation. And there's already, again, a lot of friction been introduced to our trade relationships. And I'm not sure you want to do another round of inflationary actions in the face of all that.
So what does this mean for markets? In public markets, you've seen some spread widening.
Yes.
Nothing crazy, but it's there. In private markets, in public markets, you saw the widening. In private markets, you gave me an amazing statistic that you're seeing some funds being sold 90 cents on the dollar, as little as 70 cents on the dollar. And you told me that this is before the tariff negotiations started.
That's correct. In fact, I probably misquoted the low end. I think it's even lower than that in some cases. We've seen and done trades at, in the 50-cent range. So what I would say is this. If you look at all the major asset classes that we focus on, we're primarily sub-investment grade. It's high-yield leveraged loans. It's private credit. And triple Bs. We occasionally look at triple Bs as well. High yield is about 385 basis points over right now. It got as low as 260. It's got as high as 460. So it's right in the middle of its range. Loans is wider of that. Those would imply we're at a very normal state in the credit markets, which I find ironic because this is anything but normal. These are unprecedented economic times. So as you look, I think it is starting to create some desire on the part of large institutional credit holders to get out of this before maybe there's something, before a fall. And that's where you're getting the credit secondaries. They've been pushing their GPs to get liquidity out of the funds. The GPs haven't done it at the pace that they would like. And now the LPs are taking matters into their own hands and putting credit secondaries out there for folks like us.
That gives me shivers to think about that.
Yeah.
The 50 cents on the dollar funds are being sold right now. And again, we have not potentially even seen the worst of this economy yet. What does it say about potentially problems that are being masked in private markets, given that we're not seeing daily marks on these types of assets?
Yeah, so I think what it says is to date, we haven't seen forced selling. There haven't been really dire liquidity situations that people need to address. And so these have been mostly trades of convenience where they're trying to clean up a portfolio that they have. I think we're going to get into more sort of anxious points in time where LPs will want to trade. And I think those discounts will go out further. And they don't, again, those occurred at points in time where there wasn't a lot of credit impairment going on. If we see some of the economic weakness that I believe could happen, you will start to see impairments pick up and then the discounts will be very large.
What are you seeing in terms of tariff-exposed sectors? When you're thinking about the money that you want to put to work and you're looking for that opportunity, do you find rescue deals in tariff sectors, or do you avoid it now?
Great question. So, the two most tariff-exposed industries at this juncture are retail and industrials. Retail, obviously, you're procuring your goods through a lot of countries that were affected by the tariffs. That's a direct impact on their business model. So there's got to either be a rerouting of those supply lines, or there's got to be tariff relief. Otherwise, it's going to be very difficult for them to sell at a reasonable margin. Industrials, obviously, you have goods going across the border, especially in the automotive sector, maybe multiple times. It's really hard to unsnarl those supply lines. So both of those industries are going to be impacted in a pretty significant way. My guess is this was not on anybody's bingo card coming into this year. And at this point, I think there are going to be companies that come up against a financial obligation of some form that they cannot handle through syndicated markets and will need alternative solutions, which we very well provide.
What does this mean for where bankruptcies might go in the future? Do you think that companies will face financial distress to the point of bankruptcy at a much greater rate?
If this continues on the path that it's going, the answer is yes. I mean, we've had, what we've had over the last 5 years is what we call selective default, where there's an exchange and the company does some sort of offering whereby it doesn't go into a formal restructuring, but they exchange debt. Sometimes they push out maturity, get some discount. We call those liability management exercises. That's happening with increased frequency. 10 years ago, these companies simply would have defaulted. So we'll get to the point, however, where even LMEs aren't sufficient. Companies are simply up against too many issues, whether it be a maturity or liquidity issues or just deteriorating results, where they have to restructure. So yes, we think restructurings, formal restructurings, will go up.
What does this mean for the private equity industry? Because you and I both know we've been sitting in an industry that has been doing this exercise called amend and extend for a long time, for years. Do the chickens come home to roost in this environment?
I think they do. You look at the class of LBOs or private equity investments from 2017 to 2020 particularly. They've now had 3 successive body blows, and I mentioned them all earlier: the pandemic, then the rate move, and now tariffs. And you are getting to the point where these companies are often in tenuous shape and don't have a good way to exit. Again, they can do some shifting of the chairs through liability management, but in the main, they're not changing the course of the investment, and I think they're going to have to recognize that.
I'm going to steal a word from Mark Rowan here really quickly, the fat pitch.
Yes.
It's a Stan Druckenmiller word, too. He can't only be credited for it. What is the fat pitch you're looking for right now?
Yeah, so we have, I would characterize it as sort of 3 levels of dislocation. You have sort of idiosyncratic dislocation, which is a company that's facing a specific issue to their business model. There's secular dislocation, which is an industry which is facing issues that are independent of the macro situation. And then finally, there's macro dislocation. When you get that, you see mass loss of access to syndicated markets like we saw during the financial crisis. That is the fat pitch. That's what we're looking for. And when that happens, we do, I think, some of our best work.
Bob, we thank you so much for joining us here in studio today. I know you're flying right back to the Oaktree home in LA. That is Oaktree Capital Management's co-CEO, Bob O'Leary. Next week, of course, we're going to be hosting live from Milken in Los Angeles, and we have a ton of names in credit and private markets for you. That is Mark Rowan, the Apollo CEO, Citigroup's Jane Fraser, John Gray of Blackstone, and Katie Koch of TCW, just to name a few. And of course, we're going to get a check on these markets because, of course, we have seen a spike after that Wall Street Journal news between talks between Beijing and the United States. S&P 500 even higher now, 1.6%. The Nasdaq on a tear, and even the small caps up by more than 2%. That does it from New York. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.